Imagine opening your banking app and seeing $5,000 land in your account every single month. Not from a paycheck, not from a side hustle, but from investments you set up years ago and mostly forgot about. Now imagine that entire income stream started with just $20 a week. Not $20,000, not a lump sum inheritance. $20 a week, the price of a couple of lunches out, quietly building toward five figures a year in passive income. That's what we're breaking down today, and I'm going to show you the fastest realistic path to get there. In this video, I'll show you exactly how Mike, our example investor, could take $20 a week and build it into a Fidelity index fund portfolio generating $5,000 a month in dividend income. I'll break down why speed actually matters here, the mistake that slows almost everyone down without them realizing it, the exact fund selection criteria Mike uses, and by the end, I'll walk through the real math showing the fastest realistic timeline to hit that $5,000 a month goal. This is the 2026 version of this strategy, so the numbers you're about to see reflect where things actually stand right now. Let's start with why fastest matters here, because this isn't just about eventually reaching $5,000 a month, it's about reaching it as efficiently as possible. Most dividend investing content treats every investor the same way. Pick some funds, invest consistently, wait 20 or 30 years, done. But if Mike's actual goal is speed, not just eventual success, then every decision he makes needs to be optimized for velocity. That means choosing funds not just for stability, but specifically for the combination of dividend growth rate and reinvestment efficiency that compounds the fastest. It means understanding exactly how much $20 a week can realistically become, and it means avoiding the one mistake that quietly adds years to almost everyone's timeline without them even noticing. Mistake. Under-contributing consistency. Here's what I mean. Most people start a strategy like this with enthusiasm, contribute for a few months, then life happens, a slow month, an unexpected expense, and they skip a week or two. It feels harmless in the moment. But because this strategy relies entirely on compounding, an inconsistent contribution pattern doesn't just delay Mike's progress by however many weeks he skipped. It delays it by more than that, because he also misses out on however many quarters of dividend reinvestment those skipped contributions would have generated. Skipping $20 one week can end up costing Mike months of progress by the time you account for lost compounding down the line. Consistency isn't just important here. For the fastest possible timeline, it's non-negotiable. Now let's talk about how Mike picks his Fidelity index fund specifically for speed, because not every fund is built the same way. There are three criteria Mike prioritizes when optimizing for the fastest path to $5,000 a month. First, dividend growth rate over raw starting yield. A fund with a lower yield today but a faster growth rate will actually get Mike to his income target faster than a high-yield fund that barely grows, because the growth rate compounds every single year, while a stagnant high yield just sits there. Second, sector momentum. Mike leans toward funds in sectors with strong historical growth trends, since faster appreciating share prices mean his reinvested dividends buy into a faster-growing base. And third, expense ratio. This sounds minor, but over a multi-year compounding timeline, even a small difference in fees quietly eats into returns, so Mike prioritizes Fidelity funds with historically low expense ratios to keep as much of his growth working for him as possible. Using these three criteria, here's the kind of Fidelity portfolio Mike builds for speed. He leans into a combination of a total market index fund for broad, steady compounding, a technology sector index fund for faster share price appreciation given the sector's historical growth trends, and a mid-cap index fund that tends to offer a sweet spot between the stability of large caps and the growth potential of smaller companies. This isn't the most conservative portfolio Mike could build. It's specifically weighted for velocity, accepting slightly more volatility in exchange for a faster realistic path to his income goal. Blended together, this portfolio gives Mike a combined starting dividend yield that's relatively modest, typically under 2%, but a dividend growth rate that's historically compounded well into the double digits annually, alongside share price appreciation that's historically outpaced more conservative, purely defensive fund blends. That combination, modest income today, aggressive compounding underneath, is exactly what a fastest path strategy is optimized for. Now let's get into the actual math, because this is where Mike's timeline becomes real. Mike starts with $20 a week, which works out to about $80 a month, or roughly $1,040 a year. In year one, between his contributions and early modest growth, his portfolio sits in the low four figures. A normal, unremarkable starting point for any strategy like this. By year 5, thanks to consistent contributions and the fund blend's historically strong dividend growth rate compounding annually, Mike's total contributions have grown meaningfully beyond what he's put in directly. His account is no longer just tracking his own deposits. Reinvested dividends have started meaningfully contributing to the growth. By year 10, Mike's portfolio has grown substantially, and this is typically where the dividend income itself starts becoming a genuinely noticeable monthly figure. Realistically, somewhere in the hundreds of dollars per month range. Not yet at the $5,000 target, but climbing at an accelerating pace thanks to the double-digit dividend growth rate compounding year over year. By year 15, with contributions maintained consistently the entire time and every dividend reinvested without exception, Mike's portfolio has likely crossed into six-figure territory, and monthly dividend income has climbed substantially further, driven now almost entirely by the compounding growth rate rather than his own $20 weekly contributions. And by somewhere between year 18 and year 22, depending on actual market performance and how consistently the fund blend's historical growth rate holds, Mike's portfolio could realistically reach the point where monthly dividend income crosses the $5,000 threshold, a timeline that's meaningfully faster than a purely conservative, high-stability fund blend would achieve with the same $20 weekly contribution, specifically because Mike optimized his fund selection for growth rate and sector momentum rather than just starting yield. To put that in perspective, over roughly 20 years, Mike's total out-of-pocket contributions from $20 a week add up to somewhere around $20,000 to $21. The rest of that portfolio value, the overwhelming majority of it, comes entirely from compounding dividend reinvestment and share price appreciation, not from money Mike personally contributed beyond his original weekly deposits. Now, an honest note on the trade-offs of optimizing for speed. This growth-weighted approach, leaning into technology and mid-cap exposure, will experience more volatility along the way than a more conservative, purely defensive fund blend. There will be years where Mike's portfolio value dips more sharply during market downturns than it would with a more stable allocation. The faster timeline isn't free. It comes with accepting a bumpier ride to get there. If Mike isn't comfortable with that volatility, a slightly more conservative blend would still work, just on a longer timeline. It's also worth being clear that these projections are based on historical growth patterns holding relatively steady, which isn't guaranteed. Markets don't move in straight lines, and any given fund's future dividend growth rate or share price appreciation could run faster or slower than its historical average. This is a realistic optimized path, not a promise. So here's the real takeaway. If Mike's goal is specifically the fastest realistic route to $5,000 a month in dividend income, the path isn't just about contributing $20 a week consistently, though that matters enormously. It's about deliberately choosing funds optimized for dividend growth rate and sector momentum, over simply chasing the highest starting yield, and accepting a bit more volatility along the way, in exchange for a meaningfully shorter timeline. If you want to see how this same $20 a week performs in a more conservative, lower volatility fund blend instead, and exactly how much longer that version takes to reach the same $5,000 a month goal, click the video on your screen. I run that exact comparison next.